Good afternoon. We are going to talk about bonds now. Why are we talking about bonds today? Well, because people are uncertain right now and worried, right? And when we are worried about our portfolios on the stock market, usually we use to invest some money in bonds to minimize the risk. But before we do that, let's look at risks associated with bond investments closer to see though you know if it's a good idea or not to invest in bonds in order to minimize the risk. Well, what risks are associated? We are going to talk about 6 risks associated with bonds and how bonds could bite you. Well, the first is interest risk. Bonds, it's like a seesaw relationship. When interest rates go up, the value of the bonds go down. Why? Well, because if your bond is paying you currently 5% and you can get 7% if you invest somewhere else, then when the interest rates go up, then obviously the value of your bond investment will decline because you will have to sell your bond at a lower value to people to bring them the relevant, the same return, right? 7%. Well, what's happening now with the interest rates? We were given a promise that interest rates will decline, that the interest will be lower. Now the Fed is saying that the interest rates will stay the same. What are they going to do in the future? We don't know. And the interest rates are very uncertain right now. Remember in 2022, bonds ended up to be more volatile. Bonds lost more value than the stocks because of the interest rates fluctuations and uncertainty. And now we have the same situation in 2025. So interest rates are uncertain and therefore bonds are exposed to this risk a lot right now in 2025. Risk number 2 is inflation risk. Yes, we have experienced low inflation in the past years, right? But we all know that with high government debt, with high national debt, comes inflation. Inflation loves government's debt. So whenever you have high debt, the inflation will follow. The Fed tries keeping it low, but again, we don't know for how long we are going to continue to experience lower or middle, like mild inflation. It can get higher. And again, with inflation, as inflation goes up, the savers, the investors require higher returns, higher income, and therefore, what is bonds? Fixed income instrument, right? When you require higher returns and you're not getting them, the value of your bond investment will decline. So inflation risk, again, not a good risk right now, very high right now. Risk number 3, credit risk. Well, when you apply for a mortgage, the bank determines your interest, right? They look at your profile, they look at your credit rates and your income, your credit worthiness, and they determine at what interest rate to issue a mortgage. Ditto for bonds. Bonds are rated by Moody's and Finch, and they evaluate how creditworthy is the issuer of this bond is, and therefore the safer the issuer, the lower interest rate they can pay the savers, the investors, for their investment. And the more risk the investor assumes, in other words, the junkier the bond is, the higher interest rate is required to compensate for the assumption of the risk. right? So the safest investment, the treasury bonds, right? They pay about right now about what, 4.3%. They're considered to be the safest. They pay the least interest. Well, what happens when the bond issuer gets downgraded? The interest is fixed. Let's say they pay you 5%, and then they get downgraded for some reason because they cannot pay, they cannot meet their obligations, right? So now, all of a sudden, you need to get higher interest rate from that issuer, and therefore, or the value of this issuer, that of this bond declines. We are on shaky ground right now. The economy is kind of slowing down. When the economy could slow down because of the tariffs, because we are not out of the woods with the tariffs yet. So we don't know what is going to happen. When the corporations are in tough situations, it's more difficult for them to meet their obligations and to pay their bondholders. Therefore, and some of them probably will fold. And sometimes it doesn't require a bankruptcy for the bondholders to lose their investments. Sometimes it just downgrade, like I was giving an example. So beware that credit risk is higher now in 2025. Next, liquidity risk. Well, again, when the stock market goes down, larger, even though the bond market, like money, if you look at the money invested in the bond market, is big, higher than the stock market, there are fewer traders there. So therefore, when the markets go down, it will get more difficult to offload your bond investment. And in retirement, when you are retired, you need to make sure that you have quick access to your money, right? And if it's more difficult to sell your bonds, two things will happen. You have to hold on to them, or you have to sell them at a lower price. And yes, again, liquidity risk could get really high as whatever is developing right now develops. Reinvestment risk. If everything goes well, and if you have right now a high paying bond, and this bond matures, but you cannot find, and let's say it's 5%, $100,000, 5%, you get $5,000 a year. And now this bond came to maturity. You rely on these $5,000 a year interest income, right? But now you have to reinvest this $100,000 which you received back from your corporation, from your bond issuer, and you need to reinvest it to buy a new one. And what if you cannot find a place to reinvest it to get fixed $5,000 income? So something to keep in mind. Well, but you will say, Irina, I don't care about all these risks. I don't invest in individual bonds. I buy a bond fund, an ETF. Well, like multiple bonds are managed by a manager. But bond managers have to deal with all these 5 issues I just named. They have to deal with this on regular basis. They in a bond fund, bonds maturity is staggered normally, and as they mature, the bond managers have to get the cash and reinvest it to keep two things going. Net asset value, so the value of your investments keeps, and as a bonus, income, interest income to the savers. So they have to keep two things going. And sometimes as markets get turbulent, if they cannot find the same returns, the same interest returns, they have to go either to riskier bonds or to invest in a lower paying bond. And sometimes when people panic and start selling off, they have to sell sometimes their best bonds in order to keep up with the liquidations. So again, in a bond fund, you are still exposed to these basic risks: interest rate risk, which is high; inflation risk, which is high; credit worthiness, liquidity, and reinvestment risk. So even though bonds used to be a safer place to keep your money, now we say, maybe not so much. But what are the alternatives, you might say? Well, the alternatives would depend on your stage in life and on your goals. It could be that a better place would be an annuity, either income annuity, fixed, not variable annuity, fixed indexed annuity, either income based or growth based. Or it could be that another alternative to a bond could be hedge fund like investment, where the managers of those fund portfolio managers go in, trade actively, manage the funds actively, and their goal is not to follow the stock market, where they can still generate positive returns even the stock market declines. So these are the best alternatives we see for the bond investments. But again, this is not an investment advice. This video is not intended as an individual investment advice. This is educational, informational video only. For individual advice, please consult a financial professional. If you want advice from us, reach out to us. The information is in the description. Feel free to email, call, or text, and we'll talk. Until the next time, next week, I don't know yet what we are going to talk about. We probably will talk about CDs. Probably. All right. Until the next time, have a wonderful week, and we'll see each other soon.